Ladies and gentlemen, good day and welcome to the Q2 FY26 earnings conference call of Parag Milk Foods Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Brian DePena, Head Investor Relations. Thank you, and over to you, sir.
Good day, good afternoon, everyone, and a warm welcome to the Quarter 2 FY26 earnings call of Parag Milk Foods Limited. We are glad to have you all join this meeting. For the main meeting today, we have with us our Executive Director, Ms. Akshali Shah, Chief Operating Officer, Mr. Rahul Kumar Srivastav, our Chief Strategy Officer, Mr. Ankit Jain, and myself, Head of Investor Relations, Brian DePena. After the opening remarks conclude, we will commence with the Q&A session. While asking a question, request you to announce your name and organization. For the purpose of completeness, I do want to read out our safe harbor statement. Certain statements in this meeting with regard to our future growth prospects are forward-looking statements, which involve a number of risks and uncertainties that could cause actual results to differ materially from those in such forward-looking statements. I now hand over to Ms. Akshali Shah for the opening remarks. Over to you, Akshali.
Thank you, Brian. Good afternoon, everyone. It's wonderful to connect with you all again. I hope you and your families had a joyful festive season. As I speak to you today, I feel proud and energized by the remarkable progress we've made over the past 6 months. Q2 FY26 has truly been a milestone quarter. For the first time in Parag's history, we've crossed the 1,000 crore quarterly revenue mark, reaching 1,008 crore in revenue. That's a 16% year-on-year growth, backed by a solid 10% volume growth. Looking at the first half of this year, the story becomes even more encouraging. H1 FY26 revenue stood at 1,859 crores, a 14% increase year-on-year. These numbers are not just financial metrics. They reflect our consistency, solid business fundamentals, and most importantly, the trust consumers place in our brand every single day. Our core categories, that is ghee, cheese, and paneer, continue to lead the way, growing by 14% in volume this quarter. Together, they now contribute to 59% of our total revenue, reaffirming the strength and the potential of our core category portfolio itself. Our new age business, Pride of Cows and Avatar, together have grown by 79% year-on-year and now contribute to 9% of our total turnover, up from 6% last year. Avatar has continued its remarkable growth trajectory, expanding 6-fold over the past 3 H1s. Building on this momentum, we have now entered the protein snacking segment with the launch of the Avatar Protein Wafer Bar, an innovation that blends great taste and functional nutrition. This marks another step towards addressing protein deficiency through different formats of nutrition-rich products. We continue to strategically expand Pride of Cows across key metros, with Chandigarh being the latest addition to its growing footprint. The brand is also enhancing the availability across leading quick commerce platforms in multiple cities, bringing single origin farm fresh milk closer to consumers who value high quality and authenticity. Our brand building initiative this quarter showcased the powerful impact marketing, digital storytelling, content marketing, and consumer engagement across platforms. Govardhan and Go Cheese continued their successful association with Kaun Banega Crorepati for the 4th consecutive year. Govardhan led the regional marketing conversations with powerful, high-impact communication on powerful channels and popular channels like ABP Maza and TV9 Marathi. For Gochis, we also associated with a reality show called Super Dancer across television and OTT platforms. Pride of Cows continued with the campaign on What's the Source, provoking the thought, where does your milk really come from, to address the origination and authenticity of the milk. This campaign was collaborated with fashion icons like Manish Malhotra and Falguni Shenpikok. Avatar Whey Protein energized the audience through his integration with Amazon Prime web series Rise and Fall. Moving on to the commodity cycle, which continued to face headwinds, the milk prices witnessed an inflation of around 16% year-on-year and was sequentially higher by around 2% during the quarter. The average milk price during the quarter inched up to 38 rupees per litre. Despite this volatility, we have been successful in maintaining our EBITDA margins year-on-year. During this quarter, the profitability on gross margin parameters improved year-on-year on account of better product mix and enhanced operational efficiency. Sequentially, the gross margins were marginally down due to the gradual cost push. Our absolute EBITDA grew by 16% year-on-year to rupees 89 crores, with margins at 8.9% versus 8.8% last year. The bottom line, that is PAT, grew by 56% year-on-year during the quarter. During the first half of the year, we generated rupees 99 crores in operating cash flow, depicting a healthy cash flow momentum. On the balance sheet front, we diligently optimized the capital structure. During this quarter, the FCCB issued to IFC in 2021 got converted into equity. You would also know during Q1, we had a fresh round of equity infusion as well. As a result, our consolidated net debt reduced by rupees 125 crores. From a consolidated net debt levels of 561 crores as on March 2025 to rupees 436 crores as on September 2025. This deleveraging has strengthened our gearing ratios, bringing our net debt to EBITDA levels to 1.4 times and net debt to equity to 0.4 times. Our continued efforts towards strengthening the capital structure has resulted in a strong financial position, supported by operating free cash flows and a well-managed working capital. This quarter's performance reflects our team's dedication, whose efficiencies has driven strong growth and seamless execution. As a company, our focus remains very clear to evolve from a dairy FMCG business into a health and nutrition company. Thank you for the patient listening. To sum up, Q2 FY26 has truly been a milestone quarter, one that not only marks a historic achievement with revenues crossing the 1,000 crore mark, debt reduction of rupees 125 crores, and a PAT growth of 56%, but also a testimony to our belief on strong business fundamentals with deeper consumer connect and sustainable profitable growth. Thank you. I would request now Brian to step in and open the forum for Q&A.
We will wait for a few minutes while the question queue assembles.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good afternoon, team. I have two forward-looking questions. First is looking beyond the near-term numbers. What is the bigger plan for Parag Milk as the dairy industry shifts towards premium nutrition and branded products? how are you positioning Parag to build a lasting edge? Something that goes beyond, milk collection or cheese volumes and makes the company stronger and hard for your competitors to copy. Thank you. That's my first question. I'll ask the second question later.
Yeah, hi. The first question with respect to the medium-term vision. See, we have already stated a vision of 10,000 crore couple of months back, where our chairman stated the vision, and we are all working towards achieving that milestone. The short-term item like update on what is the outlook for the year, we do not per se give a specific number for the outlook for the year. However, we continue to stay to our vision of 10,000 crores. In terms of copying entrance, etc., see, we are focusing a lot on the protein segment. If you look at our new age business is now comprising of 9%. So, entry barrier for a product like pride of cows, which is farm to home concept versus, and with respect to having protein created in-house and instead of being only imported. These are some of the things which are definitely entry barriers. But additionally, we are looking at entering into building upon the protein segment. So that's why you see we have launched protein wafer bar in the snacking category.
And one more point I would like to add with what Ankit has said, that though we are basically focusing on new age product, which is primarily protein and various variant of protein category, but to give the best quality of protein products, we have to produce whey protein at our end, for which we have to produce more cheese, so that we get the best quality of whey, and then we can produce the whey protein. So because of that, we have to continue growing in cheese category also, though this is also a growing category, and we are number 2 in that category. So we take the market share and growth in that category, so that we get the raw material for our protein products, which are very important for getting the good quality protein, which is our new age category, which is very focused in coming future. So we will see a lot of protein products in coming quarters from Parag. But for that, we have to make more cheese, so to get the raw material for protein, so that we have the best quality and best economical products for protein.
Understood. My second question is on margins and cost planning. When costs are going to rise or costs rise, like in milk collection, packaging, or logistics, how do you make sure margins stay steady without slowing down growth? Is there any system that you will be putting into place that will help you keep the profit margin stable, even when things sometimes get out of control? I would like to hear your view on this. Thank you.
As you see, in quarter 2, we had an inflation of 16% YOY, so a significant cost push. So how we have been able to maintain our EBITDA margins, and we have been able to pass on that cost push. There are a couple of items which supports this. Number one, the ability to pass on the cost push to the consumers, whereby you are able to charge more. So the brand has the pricing power. Even though we are premium to a lot of our competition within branded cow ghee segment, we have still been able to deliver a strong 14% volume growth in the core categories. So this is one part. The second is the improved product mix. As we see, the new age business has grown over a period of time from 2% to 3% to 6% to now 9%. Over a period of time, the new age business mix, as the mix improves, the profitability, of course, improves. The third is cost efficiencies. We all are working internally to look into each line item of the cost and improve. We have already taken basically a cost reduction agenda, and we are driving on to drive the cost efficiencies. So with this, we are pretty sure that we are able to maintain it, which we have demonstrated it. And in the last 4 years, if you look at We have consistently improved our EBITDA margins, gross margins. So the journey continues, and we hope to keep a track on this basis. I hope this answers.
Thank you for the guidance. May I know your good
Mr.
name for my
Patil,
record, please?
I'm sorry to. Yes.
Yeah, my name is Ankit Jain.
Okay, thanks. Thanks a lot, and best of luck for future. Yeah, thank you. Thank you, Steve.
Thank you. Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to one per participant. Should you have a follow-up question, please rejoin the queue. We'll take the next question from the line of Anirudh K from Copper Capital. Please go ahead.
Thank you so much for the opportunity. I had a couple of questions. One, and first of all, many congratulations on a fabulous quarter. I think crossing 1,000 crore sales with such increase in new age business and the core categories is absolutely excellent. So congratulations to the entire team. My first question is, we've had on the core categories, we have had 14% volume growth, and similar on the new age business, we have grown significantly there. Could you kind of throw more color, especially on the core categories of, is it because of the older distributors in terms of the general retail, and I'm new to the business, so same store sales growth is higher, same store distributor growth, right? Or is it like explosion of new distributors that we have appointed that has created this volume growth? It will be very helpful for us.
Thank you for the appreciation. See, the core categories, we believe fundamentally that there is enough potential in our core categories itself to gain the market share, to explode into the newer outlets, as well as to grow deeper where we are already existing. The growth of 14% across, it's a mix of a couple of products like ghee, cheese, and paneer. This 14% underlying volume growth is a result of overall growth. It is not one that it is the same store growth or it is only a distribution expansion-led growth. It's a holistic growth for the entire core categories. Similarly, while new age business in quarter one itself also was 9% as a share, now in quarter two also the share remains. Basically, there is a strong growth. You would have noticed there is a 79% growth during quarter two in new age business. So if the new age business is growing significantly over the base core categories, the percentage share improves.
Got it. Okay. Second question, sir, is we had an ambition of reaching double-digit EBITDA margins for the next couple of years. And I'm just confused. Again, I'm new to the business. The other income, and I've read through a lot of quarter con calls, there's a lot of question on other income because it's primarily non-cash. So when you say EBITDA is going to go double digit, is it core EBITDA as in the business EBITDA, or is it including other income? And if management can confirm if core EBITDA will also reach double digits in the next couple of years.
Yeah, see, while we have given a guidance for the medium term to improve to get to double digits, we are stepping up gradually in terms of our EBITDA margins, and which we see now hovering around 8.9% during quarter two, and at a H1 level it is around 8.3%. So when we talk of EBITDA, we are all talking of EBITDA with other income. However, other income items are not only the non-cash items. There are other one-off items which continuously are there, because many a times these other items are relating to items which are already part of other expenses at some or the other point of time. So hence, the other income is not a purely non-cash item, which I would like to highlight.
Got it. So clarification is core EBITDA, we still don't know whether it will reach double digit or not.
See, EBITDA is a journey. While we are stepping up EBITDA, the whole objective is how do we grow the EBITDA to double digit first. See, we have to achieve first overall, and then we will step it up on to teens. Now, how much is with this, without this? We are not sharing. See, as a company, we look at EBITDA as earning before interest, depreciation, and tax. So to that extent, I don't think we have a separate item on other income, etc., in terms of core. We should look at the fund. So if we were to remove other income, if we were to remove other income in this quarter itself, on a consolidated basis, our EBITDA margin is 7.1% and versus 6.9% last year. And if we were to look at the PAT growth, which is 56% as optically reported, if we were to exclude the other income completely, the PAT growth is 114%. So there will be one-off items. There will be certain items which are there, and it cannot be only non-cash. The idea over here of presenting you that over a medium term we want to step up is how we aspire to grow our EBITDA margins, which could be mainly with product mix as well as scaling up the efficiencies.
Thank you.
Got it, sir. Congratulations and all the best.
May we request all the participants to kindly limit their questions to only one participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Debashish Niyogi from Aban Dubai. Please go ahead.
Yeah. Am I audible?
Yes, sir. Please.
Yes.
Yeah. Hi. First of all, congratulations for the very good set of number, and congratulations also for the detailed presentation. Okay. I have a strategic question for Akshali, Ankit, and Rahulji. Is Parag, the way we are placed is you have all the regional players where they are focused on the region, mainly south, and their value-added contribution is very less. Whereas our value-added contribution is very high, and we are a national player after Amul. Now, Amul cannot play the premiumization game given it's the way the structure is, and while it's it cannot play the premium game what we can play. Now, my question is strategic is what Titan did to the jewelry industry 2 decades back and now still doing. In the next 10 years, do you see Parag doing the same? And if your answer to this is yes, what are the strategic steps we are taking to do this? And in that, one of the most important things is corporate governance. We had some checkered past, some checkered history, and the market doesn't seem to believe Parag management because for whatever reason, I don't know true or false. So my question is, can Parag play the jewelry what Titan did in the value-added product in the category? Because the conversion from unorganized to organized is a huge scope. The category size is very high. Whether it is ghee, whether it is cheese, whether it is whey. So the question is for Akshali and Ankit. What we are doing?
Sure.
To make sure.
See, when we talk of value-added product, if we were to exclude milk, the entire business portfolio is a value-added product when we have to look at value-added perspective. Because the core category is, which is ghee, cheese, paneer, same whether new age or even ingredients, so to say, another portfolio, which is dahi, beverages, etc. So 90% of the portfolio is a value-added product business. However, the important element to keep in mind is that we still have 30% which is a B2B business and 70% is B2C now. So as the mix of B2C improves, of course, the margin between B2B and B2C varies to that extent. So that is how we see in terms of the margin. Now coming to in terms of the management, I think we have fairly stable management. All the teams are, all the business heads are in place. We have Mr. Shubhadeep Roy. I don't know whether it was introduced last time. Mr. Shubhadeep Roy joined as a Chief Business Officer during last quarter. And overall, we have a detailed, of course, organization structure within general trade, modern trade, Horeca, liquid milk, new age, and that too specifically Pride of House Avatar. So the business teams are fully loaded, power packed with professionals only, and same is for the support team, whether it is HR, IT, or finance. So with the
What about,
I think we are well poised. Sorry.
I'm saying, what about the corporate governance? Because there's been a lot of issues in the past. At least the market doesn't believe, on corporate governance. So, what we're doing on that, because there's been a big write-off in the past, right? So, market thinks that why can't it cannot happen in future. So, do you think there's an adequate check and balance in place when it comes to corporate governance? And do you think, we are in... My question is, was to Akshali. Can we play the jewelry what Titan did in that category? Can we attempt to do that? Is there a vision to do that, or we are asking too much in the next one decade?
Okay. So you're asking two questions, saying that first is on the corporate governance front, and we've had a write-off in the past. And, of course, COVID was a one-time phenomenon, and this was almost 4 years back that we'd actually taken a write-off. And if you see that the past 8-9 quarters, you can see the consistency in our performance. If you see, we've also done a lot of, it's actually been a Parag 2.0 journey. The board, we've had a new fresh board. We've also appointed Deloitte as our internal auditors. Yeah. And we've also strengthened our, management. You've met people across. So we have Ankit, who's joined in almost 3 years back. We have Rahul, who's joined. Shubhadeep, who's come from, who's headed big FMCG revenues, and now he's here. We also have somebody who's heading Avatar separately and Pride of House separately. So on corporate governance front, we're all geared up for Parag 2.0. Coming to your thing on the value creation and how do you see. So of course, he explained the aspect that 90% of our revenues are coming from value added products, but channel mix around B2C is around 70% and B2B is around 30%, if you've seen in the presentation. Moving forward, there's also one segment that we're creating, which is of health and nutrition, and that's where we see that we're going from direct to consumers. Yeah, you can see 2 D2C brands which are coming in from there. So that's also growing, which is almost growing by 80% year on year, and we see that as really, really big. And we operate in categories like ghee, cheese, paneer, which are actually growing in double digits itself, right? So the category itself is growing really, really big. Plus, in the dairy industry, you see a big change that is happening from unorganized to organized. So there's a rapid change which is happening, saying that people prefer packaged dairy products because they believe in quality and consistency. So that's another change that you see in the industry, and we are gaining the most out of this. So in the future, and I think Rahul will be able to add better on the segment of how dairy is becoming from unorganized to organized. Then
yeah. So that's a very the kind of addressable market which is we can count. The very big shift from unorganized to organized, as you can see also. Like the simple example I give you about the paneer. That 5 years back, the paneer market was there. Now it is it has multiplied. Even dahi,
nobody would have thought 10 years back.
10 years ago,
buying dahi from outside, but now.
So basically, what we call it, the competition is not between the players, but competition is between unorganized and organized. The way the unorganized sector is shifting towards organized, gives a very big platform to grow a dairy company like us, which have all the categories products available with the best quality products, as well as distribution with the proper branding, proper brands behind the products. So that's what it's a strategical pillars what we are operating on. The market growth is there. We have brands, we have product quality, and we have distribution.
I also believe we are a little one step ahead of the value-added piece. If you see that we've recently gotten into a protein snacking segment, and we have a huge lineup coming in the next 2 quarters in the protein snack segment, where you're selling 10 grams of protein in protein wafer bar, which is again a value add from a protein powder. We've gotten into a snacking piece, and there is a line of product that we have coming in the protein segment. Similarly, what we did with ghee, we did a forward integration. We've launched sweets. We've launched Kaju Katli and Peda and things like that, which is actually a forward integration. It's like a value addition for ghee as well. And our chikki as well with ghee. That's also doing really, really well. So yeah, this is, I hope this answers your question.
Yeah, actually, thanks for a very, very detailed answer, and thank you, Ankit and Rahulji, for a detailed answer. Thank you. I'll come in the queue next.
Thank
To
you.
ask my second question.
The next question is from the line of Darshan Shah from Trust Group. Please go ahead.
Hi, a couple of questions. One, in terms of regional salience between North, West, East, and South, how are your sales regionally? That is question number one. And could you share specific numbers in terms of what is the distribution growth, what is the throughput growth, and what's the growth across channels between GT, modern trade, e-commerce, and B2B?
So thanks for your question. But as you would know, we are not giving selective specific information. What we give is a dissection of our composition of the turnover in a standard format of defining into core categories, nuances, etc. Geographical mix, there will be ups and downs. There will be different mix for different products. So we do not share on a weighted average what is the geographical mix, or so for that matter, a channel mix. We do share our B2B and B2C mix, which we have shared for the half year. It is 70% for as B2C and 30% as B2C.
Okay, some salience of regional would have been helpful, but in that case, if you could just help me understand, you've seen a 16% growth in milk prices, but only a 6% price growth, given that your value growth is 16% and volume is 10%, so price plus mix is 6%, but input costs have increased by 16%. So going forward, do you see that higher input cost impacting your margins, considering the price hikes that you've taken are at 6%?
Yeah, first of all, I would like to clarify that on a weighted average basis, while 10% and 16% is the right number, but there is a mix of portfolio which includes new age business, which doesn't get impacted much with the inflation. So what gets impacted is the core categories, and hence you see a differential growth of 14% volume growth and 23% value growth in the core categories for the quarter. Again, see, typically like any other FMCG company, commodities fluctuation is a reality, and it will come and play every quarter. So it is our ability to manage the show, given the brand pricing power, given the portfolio mix, and identifying the opportunities to optimize on the cost, basically cost efficiencies. So all in all, I think we see that the brand has the pricing power. Today we command 20%, almost close to 20% premium than one of our competition, which is again a leading player in branded cow ghee segment. So having said that, while commanding a premium, it is about our ability to pass on a timely basis. So I think that is where we see that we are proactive in taking up calls. It may sound very hard when we take such calls, but at the same time, our ability to forecast and properly pass it on a timely basis is something you can see the demonstration during quarter two itself.
In terms of your procurement, direct procurement versus aggregator procurement, if you could share that.
Mr. Shah, I would request you to kindly rejoin the queue. I'm sorry, sir. We can't take further questions, please. There are others who are waiting for their turn. Thank you. Kindly limit your questions to one per participant. Should you have a follow-up question, please rejoin the queue. We'll take the next question from Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity, and congratulations the entire team at Parag for a wonderful set of numbers, including crossing the 1,000 crores milestone. So, my question is with regards to the core categories. The previous participant did ask about, the drivers or what led to basically the core categories growing 14% volume and 23% value growth. So, going ahead, how do we look at this category, entire category ghee and cheese, where we have a very large market share, with a of 22% and 35%. At the same time, paneer is there in the core category. So going ahead, sir, what kind of growth do we see in this category? Also, given the situation where the GST cut has been implemented, so any of these products, where do you feel the maximum benefits could come in, and thereby that will be our focus area?
See, with respect to core categories, we have distinctly identified the underlying volume growth because, see, commodity like fluctuation today, it's an inflationary environment. Tomorrow, it may be deflationary. So the pricing will vary to that extent. So hence, to forecast that it will be a 23% growth always with a volume growth of 14% or 15% is not ever cast in stone, because value growths will differ. Having said that, if we are growing in volumes, if we are growing onto keeping our share or rather increasing our share, I think that is more which is focused upon. In GST, of course, we had to pass on, while there was a benefit on account of the rate reduction, and specifically in most of our categories which we operate in. So we have passed on the benefit to consumers and reduced the prices. Having said that, there are categories where even the GST has been made zero. So, for example, paneer, a category like paneer, this gives an opportunity to again further deepen between the unorganized versus organized. So, of course, in a medium to longer term, the GST relief will benefit the demand for the industry as such. We are believing that the good quality products, I think consumers are looking at and they're willing to spend actually. So while they are maintaining their lifestyle, they are willing to spend that premium for a branded product, and hence we foresee that the organized share is going to grow significantly higher than the unorganized sector.
Sure. So any additional geography which is contributing to this volume growth in core categories and which could probably sustain going ahead?
See, geographically, we are spread across. We are pan-India present when it comes to ghee, cheese, paneer, in terms of the core categories. In terms of new age, we are present pan-India for Avatar. But however, for Pride of Cows only, we are present in 8 cities. But most of our portfolio, barring Pride of Cows, is available pan-India. We have 29 depots across the country, through which we cater to all the regional markets.
Thank you. We'll take the next question from the line of Parikshit Gujarati from Free Ventures. Please go ahead.
Hello. Thank you for the opportunity, sir. So I had a question on the protein side, that the whey protein market is highly competitive. So what is the strategy to establish your brand in this market? And also, what kind of growth do you expect in this market in the next 2 to 3 years?
Protein is a growing market and one of the fastest, I would say. It's growing at a very high pace. Not I would say literacy, but the knowledge about deficiency in protein, of protein in an Indian diet, the awareness of the consumers is increasing, and the fitness quotient of consumers are increasing. So hence, the category is growing at a very, very fast pace. We created our brand a couple of years back, 4 years back maybe. Why? Because we were creating whey protein earlier, but we were supplying as a B2B player. Now we saw an opportunity into the country whereby the whey protein is all imported into the country, and no one knows the source, no one knows how much adulteration it has, etc., etc. So we found a niche that there is an opportunity whereby we will be able to create our own B2C brand instead of being only a B2B player, and that is where we created this brand Avatar.
See, just to add to this, 80% of India is protein deficient, and as you mentioned, that the awareness is becoming really, really high on what should be the protein intake. Yeah, looking at this, we see around in the next 3 to 4 years, around 20% of our portfolio would be coming from the health and nutrition business.
Great. So following to this, add
Sir, your voice is not clear. Sir,
hello,
please
I'm audible now?
There are others who are waiting for
We
you.
can't
I would request. Mr. Gujarati, I would request you to kindly rejoin the queue for follow-up questions, please. A reminder to all the participants to kindly limit their questions to only one per participant. The next question is from the line of Dhanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone. My question is, in the commentary, we talked about inflationary environment being persistent. But when we listen to the other dairy calls, they talked about the flush season leading to lower milk prices and hence better margins, going forward. So, is it because of our geographical presence that our commentary is different? Any thoughts on that?
See, what we have presented is the actual for the quarter. 16% inflation is actual for the quarter. We have not given a forward-looking statement. However, in the statement of our executive director, you will find in the media release that we see that the inflation is going to continue even the post-festive. So it's been already 1.5 months post-festive, in fact, post the quarter, sorry. We see the prices remaining stable to what it were, and we don't foresee. So again, it is about a forecast which we are not giving at this point of time. But the overall prices in the inflationary environment remains wherever it is.
Yes, it is forecasted is stable. Right now, this forecasted is stable.
Okay, got it. And one thing that you alluded to.
So may we request you to kindly rejoin the queue? Thank you. We'll take the next question from the line of Preet Nagarset from Wealth Finvisor. Please go ahead.
Yes, hi. So the question I wanted to better understand from you, Ankit, was the reference you made in your last call about how the margins, and I'm assuming including in other income in it, how we combine the margins on the EBITDA side would inch up to low teens. So say right from the current 8.99 to low teens at 13, 14, and within the next, say, 24 months is the statement that was made. One is the first part is that on track from your end, and how do you get there? If you could explain that would be a great help.
Sorry, if you could repeat your question because I want to answer very specific. If you can elaborate, how do you get there? I could not get your question clearly.
Sure. So my question is, how do you go from the current 8.9% EBITDA margins to low teens to somewhere around 13, 14 over the next 24 months, based on the commentary you must have made in your last call?
Yeah, see, that is again an aspiration. As you look at our EBITDA margins, we have inched up our EBITDA margins consistently from 5.5% to 7.5% to 8.5%, and currently also at around 8.9% for the quarter. So we are stepping it up gradually through various ways and means. Of course, improved product portfolio mix, operational efficiencies are fundamental parameters to the same, and the price premium index, which is the ability of the brand to charge the pricing to the consumer. Of course, as well as the channel mix. Our channel mix has improved from 65% B2C to 70% B2C. So with all these efforts, and there is, of course, a conscious effort how to improve the margins to first double digit and then to enter into teens. This is more of an aspirational or the visionary thing. While we are working upon all this, we are not giving a specific forecast in which year we are going to have a double digit margin or a teen margin. But as we move towards our target for 10,000 crores, I think you will see more that as a reality rather than we commenting on when do we do.
Understood. Thank you, Ankit.
Thank you. The next question is from the line of Resham Mehta from GreenEdge Wealth. Please go ahead.
Yeah, thank you. So I just wanted to understand, so the ghee market is close to 1 trillion or maybe a little bit more. How big would the cow ghee market be out of this? Hello?
So, so overall, hello?
Yes, sir, you're audible. Please proceed. Yes.
Yeah. So when we're talking of this market size, this is a market size which has both organized segment as well as unorganized segment, right? When we talk about our market share, it is specific to the branded cow ghee segment, what we talk about, which is a very small subset of this market, because in overall ghee market, there is a majority of portion which is a buffalo ghee or a mixed ghee versus only a cow ghee, and that too within the branded segment.
No, which is fine. But all I'm trying to ask is that out of the almost over a 1 trillion ghee market, both organized and unorganized put together, how big would the cow ghee market be?
Sorry, if you could repeat your question.
Yeah. So I'm saying the total ghee market is close to over 1 trillion, which is both organized and unorganized put together. So out of this 1 trillion, how big is the cow ghee market? Which includes both organized as well as unorganized.
Yeah. So it is around 6,000 odd crores when it comes to the pricing in the market.
Which is organized plus unorganized.
No, only the organized market.
So cow ghee organized is 6,000 crores. And how big would be the overall cow ghee market? Any estimates?
It will be for the unorganized one, we don't have the market share.
Because there are people who still bring milk at home, separate the cream and separate the buttermilk.
Ma'am, your audio is low. Can you repeat that?
Very difficult to get the unorganized numbers, because there are households which still get milk at home, separate the butter and separate the buttermilk, and then make ghee on their own. So that's a large portion as well. So, but now, as I mentioned, it's rapidly changing in the coming time. So very difficult to get the unorganized numbers.
Overall dairy category, whatever market is there, only 30% goes to organized. That is what, is a bigger vacuum which is creating a lot of market. So overall, I'm talking about ghee in particular is difficult to tell, but overall.
Yeah, even the IMARC report which we subscribe to, it only caters a bifurcation with respect to organized sector. Unorganized is something which is not very specific to be estimated. Very difficult to estimate actually.
And as per that report, how big is the organized ghee market, overall organized ghee market?
Yeah. So I told now, overall branded cow ghee segment is close to around 7,000 odd crores.
No, I was asking the overall organized ghee market, buffalo plus cow plus mixed ghee, all put together, as per that report.
We don't do buffalo ghee, Reshma.
Okay, maybe I'll take this offline.
Ms. Mehta, please rejoin for follow-ups. Thank you, ma'am. We'll take the next question from the line of Aditya Agarwal from Fin Avenue. Please go ahead.
Good afternoon, sir. Am I audible?
Yes, sir. Please proceed.
Yes.
Yeah. Sir, in the past 3 years, like from March 23 to, the current year, our growth in value-added segments, that is protein, is mainly from, price hike of our products as per our channel check. So can you guide us on the volume growth of Avatar protein in past 3 years in the market, like the absolute volume growth and the strategy from here on for Avatar protein? Because I was getting the feedback that our proteins are almost priced at par with the imported brands such as On. So why would a consumer prefer the likes of our brand as compared to, the more, known ones such as On and, muscle base?
While we are not giving a specific number and we will not give, but I would say there is hardly any gap between the volume and value growth for Avatar. So, for Avatar, I'm not sure what you're hearing. See, overall, because of the protein deficiency, the protein itself is very rarely available, and hence the protein market is inching up to that extent. So overall, our volume growth and value growth is almost in line. And your question was more on pricing. So we have discounted the price. Post GST, we have reduced the pricing. So this is a continuous way of working, specifically for brands like this. As you rightly mentioned, with respect to On, we have to look at the variants. See, if you look at variants, whether it is On, Muscle Base, or any other brand for that matter, we need to look into the composition and not directly just one pack, because there's so much of complexity within this protein segment, that what is the blend, what is the pure iso, purity of the protein basically. So based on that, and that is why you see products which has been entered. So we have last year we introduced performance whey into our basket. This quarter we added fuel whey into our basket. So we have to tap each consumer segment again, which is a beginner or which is looking for a low cost protein versus a pure protein consumer who wants iso-rich or protein isolate levels of protein. So it will vary. The pricing will vary according to the type of protein.
Thank you.
Okay. I will rejoin the
Thank you,
session.
sir. Thank you, sir. We'll take the next question from the line of Harsh Shah from Seven Rivers Holdings. Please go ahead.
Hi. Good afternoon, sir, and congratulations for growing at a very fast pace. So one question I had more on bookkeeping side. So if I look at our FY25 numbers, there is this 100 crore of incentive that we have received, I guess, from the Maharashtra government. Now, last year our total EBITDA was 250 crore if we exclude the other income. Out of that, 100 crore was contributed by these incentives, which I believe is expected to go away next year. So how do we expect to fill this gap of this 100 odd crore which which is like 100% flow through to EBITDA? If that goes away 100 crore, how do we expect to fill this gap?
See, first of all, it is not equal to 100 crore. This is broadly around 85 odd crores. The milk subsidy is part of the actually milk costing, because there was a specific circular from Maharashtra government, and that too for a specific 4-month window, whereby it was more of a compensation for the amount which we paid to the farmers. It's the accounting treatment that we have to recognize subsidy separately. That is why you see it as part of the operating revenues. However, if you were to look at overall margin, we maintain the margin, and given the fact that these are state benefits, we cannot look that in isolation. So our pricing assumes these kind of margins. So for example, when the GST rate reduction was announced, this is the impact on account of the state incentives which are linked to pure SGST. So this is part of the pricing. That is one. Having said that, this is more of a reimbursement in nature for the capital expenditure which the company has already done. If we were to knock off the depreciation versus the income on account of it, hardly there will be 20 crores of additional impact versus 80 odd crores of impact.
No, you mean once the incentive goes away, your depreciation will start to come down?
Start to come down. See, it has been going on for the past 7 to 8 years, and various schemes which have been announced time and again, and where we have to apply, we have to get the eligibility certificate, and then so there is a whole lot of process on getting these schemes. See, as a part of the revenue recognition, we have to accrue it. That is why we are accruing it.
No,
Mr. Shah,
so my question is, will this continue? No, this is just a follow-up. So will this 86 to 90 crore of incentive income, will it continue for foreseeable future? I mean, will we keep on getting this incentive?
Yeah, so this incentive is going to continue for next 7 to 8 years. However, it will not be as high as this because there are two items to it. One is there is of course an incentive cap. Last year we had an additional incentive of one more year. That is one point. So this year overall number is supposed to come down. Additionally, with the change in the GST rates, this incentive is going to further come down.
Okay, got it.
I mean to say, this is part of the pricing process.
Okay, sure. Maybe we will take this offline. Sure, thanks.
Thank you. The next question is from the line of Pranjal Mukhija from GrowthSphere Ventures LLP. Please go ahead.
Hi, am I audible?
Yes, sir. Please proceed.
Yeah, thank you for giving me this opportunity and congratulations on a great set of numbers. So I just have one question on the protein side. I just wanted to understand, I mean, how are we positioning ourselves here in this market in terms of, what is the strategy in terms of positioning and branding, especially now that the largest milk manufacturer is also, stepping in the market, protein market. Yeah, I just wanted to understand how we're positioning ourselves. Thank you.
You're talking of whey protein specifically, or the overall protein segment, whereby in every product we mention this is a protein, because inherently milk has protein, and every product which is made from milk will have some or the other protein level.
The protein segment, the powder and the wafer bars and that particular segment.
You're talking of the whey protein segment, right?
Right.
So in whey protein, I think we have answered this question earlier also. Protein is a market which is growing on a rapid pace, and we have found our space to, of course, step into that and take the opportunity to lead into the protein segment, because we are producing our own whey, we are producing our own protein, and there will be a differentiation between a protein which is imported into the country versus protein which is produced in the country. There are other players who are producing, that is okay, but it is about establishing the niche, establishing the purity of the protein. And having said that, it is not that we have just launched this brand 4-5 years ago and we have got the expertise in the protein. We are doing protein for maybe more than a decade. Previously, it was more of a B2B business. Now it is B2C business. So we understand the kind of protein. In fact, as we move forward, we will have different ways of newer ways of protein, which of course we cannot say specifically, but the protein market itself is evolving as we talk. So you'll find various new products coming into our basket as we move along.
So just rephrasing it, Amul entering the market will not impact us anywhere.
No. Definitely no.
Okay. Thank you.
Thank you.
Next
question.
It might rather help in educating the customers. Yeah, sure.
And help in creating awareness and yeah.
Thank you, ma'am. We'll take the next question from the line of Vishal Agarwal from GB Capital. Please go ahead.
Hi, good afternoon.
So my question is that, with respect to the vision that has been articulated by the management of around 10,000 crore revenue in 3 to 5 years and the EBITDA margin of mid-teens. The question is, what are the key risks, key constraints and challenges that you see in achieving that?
See, when we look at opportunity, of course, it comes along with challenges to combat with. Then only we will be able to turn the opportunity into your favor. So what we see, your question is very specific to the risk and the challenges. So I'm straight away moving on to the risk. The risk is procurement. How do we have a stable procurement? How do we increase our procurement scale from today's 15 lakh liters to say 40 lakh liters over a period of time? How do we go into increasing our share of having BMCs versus the overall aggregator-based milk procurement? So these are things on the procurement side. Same way, the opportunity exists in expanding our distribution network. Now, how do we enter deep into the south? How do we enter more? How do we penetrate more into northern geography, etc.? So these are distribution-led drives which we will be doing over a period of time. Now, the risk and challenge is more about how do we execute. If we are able to execute well to our strategy, we will be home, right? So the core risk or challenge lies in executing. I think execution remains, and that is given for anyone, any organization. How do we execute well onto our strategy?
Okay, then in that case, sir, what is our right to win? This is a very competitive market. You have Hatsun, Heritage, Dodla, you have Amul, you have many unorganized players. So in this segment, what is our right to win?
So right to win is a great right to win, and that is where our fundamental belief into the business which we operate in. So whether it is core categories to new age business to any other category which we operate in, we significantly believe, we strongly believe that we have a significant right to win. When it comes to branded cow ghee segment, today our market share is only 22%. What if the market share increases significantly? Today we are present in, while we are present pan-India, but there is strong penetration which can happen deep south or maybe a higher level of distribution even in north. So even in core categories, we believe that there is a lot more to do. When it comes to cheese as a category, while we have a 35% market share and we are number 2, but still in cheese we are big in Horeca. So there is a big consumer segment which we are focusing upon, and that's where you saw we entering into association with KBC, or last year with Big Boss, or maybe influencer-led campaigns, etc. All the brand building initiatives taken to grow even the consumer cheese. Initially or traditionally, we focus more on Horeca and we gain the market share. And today we are focusing on consumer cheese besides Horeca, since that is already there. So in category like paneer, again it is growing significantly with high adulteration in the unorganized market. So there is enough potential to grow the category itself, the organized share. When we say. So this is not only just the core categories. If you look at the entire portfolio, whether it is new age business, we believe we have spoken more on Avatar. We have, Pride of Cows. Both these brands have immense potential to explode basically. So I'm again limiting on to this, but the other categories also are there, which is liquid milk, which is growing fast and which is catching up. So if you look at our liquid milk share has broadly remained stable, which means the same is also growing. It helps in optimizing on our working capital. So all in all segments have to grow and has the potential to grow. Having said that, with respect to competition, I am not commenting to a specific name. You have named a few, but there are regional players which and largely into the liquid milk or ice cream segment, etc., or maybe curd. They are limited segments. There is no one direct competition or a direct player which you can represent which has a ghee, cheese, or a whey protein, or a farm-to-home milk, etc. So we believe the fundamentals of the business and fundamental behind each brand is so strong that I don't think that we have any doubts on even on our vision only.
Thank you, sir. Thank you very much.
Mr. Agarwal, I think he left the queue, sir. We'll take the last question for today, which is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. Thanks for taking our question, and congratulations on a very good set of numbers. So the question I had is, we've generated a good, healthy 100 crores of cash flow, plus we have had 40 crores of fresh funds coming in. And despite that, if I look at your cash flow statement, we have only been able to repay 50 crores of debt. Remaining, I believe this comes from conversion of FCCB. So, just wanted to ask, why were we not able to repay more debt? One, and an extension of the same question is, what is our, interest rate on the gross debt that we have for 480 odd crores?
On 481 crores.
Yeah, and gross debt, yeah, on that, what is the interest rate on the same?
Yeah, sure. So, first of all, if you look at the cash flow statement, while it is very clear, we are focused on the cash generation, which is 99 crores for the half year. The deployment, if you look at, is largely one into capital expenditure, which we have been able to fund ourselves. That is one. And secondly, the interest payout, which is there on the existing debt. So all in all, that is why you see the delta is 125 crores, wherein FCCB component is around 80 odd crores. So we have been able to repay debt to best possible. In fact, if you look at last year also, last full year we generated almost more than 200 crores of operating cash flow, around 212, right? But still, we generated and we fueled our own internal capital expenditure as well as the interest from our generated cash only. So this is we have to steadily improve upon it. That is what we are focusing upon, and that was the message that yes, it has reduced by 125 crores. Having said that, there is the weighted average cost for all our working capital loans is around 9.25 to 9.5%.
9.5%. But then, if I look at our interest payments, that would be roughly 20 crores per quarter, which means 80 crores for the full year on 500 crores of debt. So that is not, that's higher than the percentage you are mentioning, right?
So the interest component also factors interest from ROU, which is according for the lease segment, and it also factors in receivable bill discounting, which is done to manage. So it is not corresponding directly to the gross debt.
Right. So you're saying on this 500 crores only. Hello.
So this will be the last. So that was
No,
the last
I just
question. Okay. Please proceed.
Yeah. So what I'm trying to understand is on 500 crores, what would be the pure interest component that we are paying? That would, you're saying would be less than 50 crores, and remaining 30 crores, if you can give me the breakup on lease, interest on lease and bill discounting interest that we are paying, roughly.
Yeah, even if you look at last year number, it was close to 55 crores as the pure number. So this year, certainly it should be lower than the same.
Thank you, sir. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference back to Mr. Brian DePena for closing comments. Thank you, and over to you, sir.
On behalf of Parag Milk Foods Limited, I would like to thank all of you for joining us. Have a nice evening.
Thank you, members of the management.
Thank you all.
Thank you, sir. Ladies and gentlemen, on behalf of Parag Milk Foods Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.